Warren Buffett, the wunderkind of investment success, has revealed the formula for multiplying $300 into a mind-boggling $20,000. But it's not about money all alone. It's about a bunch of secret strategies that many don't know. But what are these clandestine strategies? What are the tactics that could revolutionize your financial future? In this video, we are about to reveal it all in detail. So stick around because it's going to be a life-changing video for every one of you wanting to get rich quick. Now first, let's understand why a diversified investment portfolio is crucial for financial success. Building a diverse investment portfolio is key to financial success. Think of it as creating a strong foundation for your financial future. This strategy acts as a safeguard for your money, aiming to both protect it and optimize potential returns in the ever-changing stock market. Diversification means spreading your investments across different types like stocks, bonds, and real estate. It helps reduce risks linked to putting all your money into one thing. By dividing your resources among various sectors, you can lessen the impact of a single investment performing poorly on your overall portfolio.
I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that.
Essentially, a diversified portfolio acts as a safety net and helps you deal with market volatility. Markets can be unpredictable due to various factors, from economic indicators to global events. With a range of investments, you create a buffer against individual asset fluctuations. Diversification also offers the chance to tap into different sources of potential returns. While one sector may face challenges, another might be thriving. This approach lets you benefit from the positive trends in different market areas, potentially boosting your overall returns. Think of it like a sturdy foundation. Just as a well-built base supports a building against external pressures, a diversified portfolio supports your financial well-being. It adds stability that can withstand economic downturns, market corrections, or unexpected global events. Now that you understand why diversification is important for financial success, let's go through the steps to build your diversified investment portfolio. To kick things off, the first step is figuring out your risk tolerance and time horizon. But what does that mean? Before you start investing, it's crucial to know what you want from your investments and how comfortable you are with risks. Risk tolerance is about your ability and willingness to handle fluctuations or potential losses in your investments.
Charlie and I have had we saw a lot of problems develop in an organization that expressed their risks in sigma, and we even argued sometimes with the appropriateness of how they calculated their risk, and
it was truly horrible.
Some people prefer lower risk investments, while others are okay with higher risks for the chance of higher returns. Your time horizon is about how long you plan to stay invested. It depends on factors like your age, goals, and circumstances. For example, you might invest for a vacation next year, a wedding in a few years, or retirement decades away. Different goals have different time horizons, and generally with more time, you can take on more risk for potentially higher returns. But if you need the money sooner, like for a short-term goal, you'd want to avoid overly risky investments to make sure the value doesn't drop when you need to use it. Understanding your risk tolerance and time horizons is crucial because it guides your initial investment decisions, starting with asset allocation. Asset allocation involves dividing your investment portfolio among different asset classes like stocks, bonds, cash, and real estate, determining the percentage allocated to each. Let's make it simpler. Imagine you're 30 and aiming to retire by 65. With 30-plus years to invest, you might consider keeping 90 to 100% of your portfolio in stocks and 0 to 10% in bonds. This is because you have a long time horizon, allowing you to handle extra volatility for potentially higher returns. On the flip side, if you're 55 and want to retire by 65, a more balanced approach could be 60 to 70% in stocks and 30 to 40% in bonds. This lowers your risk since you have less time to navigate market fluctuations. The next step is investing in a mix of asset classes to diversify your portfolio. What are asset classes? Simply put, they're things you can invest in that share similarities. Asset classes include stocks, bonds, cash, and cash equivalents, along with alternative investments. Let's break it down a bit. Stocks are like owning a small piece of a big public company, also known as equities. Investing in stocks makes you a part owner, allowing you to profit from the company's growth. While stocks are considered high risk, many opt for mutual funds or exchange-traded funds, bundles of hundreds or thousands of stocks offering instant diversification in your portfolio. If you want more details on ETFs, check out our other linked videos. Now, onto bonds. Essentially IOUs issued by companies or governments to borrow money from investors. Investing in bonds means lending money to the issuer and receiving interest payments. Bonds are a low-risk option but come with lower returns. Lastly, there are cash and cash equivalents, which are easily convertible into cash. Think savings accounts, money market accounts, and certificates of deposit. These assets are generally low risk, providing modest returns. However, it's essential to note that cash and cash equivalents aren't considered traditional investments. Instead, they serve as short-term storage for your money. Moving alternative investments encompass various assets outside the typical classes. Think real estate, commodities, hedge funds, private equity, and cryptocurrency. While alternative investments offer diversity, keep in mind they can be more volatile and less liquid than traditional assets. When you invest across different asset classes like stocks, bonds, and real estate, you're engaging in portfolio diversification. This diversification is crucial for managing investment risk. By spreading your investments, you minimize losses if one part of your portfolio performs poorly. Additionally, diversification helps maximize potential returns by tapping into growth opportunities in specific markets. It also smoothens out portfolio volatility, making it manageable during market fluctuations. The next step is crafting a mix of investments within each asset class. Take the stock market, for instance. Here, you can diversify by investing in large cap, mid cap, and small cap stocks, along with international stocks. Let me break it down further. Large cap stocks belong to companies with a market cap exceeding $10 billion. Typically, these companies are well established with a history of stable earnings. While large cap stocks are considered less risky, they might have lower growth potential compared to mid cap or small cap stocks. Moving to mid cap stocks, they represent companies with a market cap between $2 billion and $10 billion. These companies are smaller and less established than large cap ones, offering greater growth potential. Also, slightly riskier than large cap stocks, they are considered less risky than small cap stocks. Now, small cap stocks are from companies with a market cap between $300 million and $2 billion. These companies are usually newer and less established than large cap or mid cap ones, potentially offering the highest growth. However, they are also the most unknown, making them the riskiest in this trio. Lastly, international stocks are just what they sound like, stocks of companies based outside the U.S. Another way to mix things up in your investment is by looking at different sectors or industries. Instead of putting all your eggs in one basket, you spread your investments across various industries in the economy. So you're on your way to building a diverse portfolio. You've sorted out your asset allocation and possibly picked the types of assets you want to invest in. And now the next step is diversifying within those asset classes. Let's focus on stocks as an example. If you opt for stocks, you aim to diversify within that category. What does that involve? It means having a mix of different types of companies instead of putting all your money into one. There are various ways to do this. You could diversify based on the size of the company, like some large cap, some mid cap, and some small cap companies. This just refers to the general size of the company. When your portfolio has a mix of large cap, mid cap, and small cap stocks, you achieve more diversification. Another approach could be diversifying by geography. So you'd have some U.S. stocks, some international stocks, and perhaps some emerging market stocks. That's another way to diversify within the realm of stocks. Another valuable step in diversifying an investment portfolio involves considering different industries. This strategy focuses on spreading investments across different sectors or industries, aiming to reduce risk exposure to any single economic sector's performance. Sectoral diversification recognizes that various sectors respond differently to economic cycles, regulatory changes, and market trends. The rationale behind sectoral diversification lies in the fact that different industries may thrive or face challenges depending on the broader economic environment. By allocating investments across multiple sectors, investors can potentially benefit from the growth of specific industries while mitigating the impact of downturns in others. To implement sectoral diversification effectively, investors need to understand the dynamics of various sectors, including their strengths, weaknesses, and potential growth drivers. Here are key considerations and examples of how sectoral diversification can be integrated into an investment strategy. The technology sector is known for innovation and rapid growth. Companies involved in software development, hardware manufacturing, and tech services can offer substantial returns. However, the sector is often characterized by high volatility. Sectoral diversification involves balancing exposure to technology with other sectors to manage risk effectively. Healthcare is a defensive sector, meaning it tends to be resilient even during economic downturns. Pharmaceutical companies, biotechnology firms, and healthcare providers constitute this sector. Investing in healthcare can provide stability to a portfolio, especially during times of market uncertainty. Consumer discretionary is another sector that can be considered. This sector includes companies that produce non-essential goods and services, such as retail, automotive, and entertainment. Consumer spending patterns are influenced by economic conditions. Diversifying across consumer discretionary and other sectors helps cushion the impact of fluctuations in consumer behavior. Now let's move to the energy sector, which includes companies involved in oil, gas, and renewable energy. Energy prices are subject to geopolitical factors and global demand. Sectoral diversification involves carefully weighing exposure to energy to manage the impact of commodity price fluctuations. Banking, insurance, and investment firms make up the financial sector. Economic conditions, interest rates, and regulatory changes can significantly affect financial stocks. Investors can diversify by including financials in their portfolio, but balancing exposure to managing risks associated with the sector's sensitivity to economic variables. To implement sectoral diversification effectively, investors can utilize exchange-traded funds or mutual funds that focus on specific sectors. These funds offer diversified exposure within a particular industry, allowing investors to gain broad sectoral exposure without picking individual stocks. It is important to note that sectoral diversification does not guarantee profits or prevent losses, as the performance of sectors can be influenced by various factors. Regular monitoring and periodic rebalancing are crucial to ensure that the portfolio maintains the desired sectoral allocation. The next step involves adjusting your portfolio. After settling on your asset allocation, considering diversification, and making investment decisions aligned with your risk tolerance and time horizon, it's crucial to ensure these choices stay consistent. Over time, though, your portfolio may naturally change as some investments outperform others. To keep things on track, it's wise to review your portfolio annually and make adjustments if needed to maintain your desired asset allocation and the right level of diversification. So, thanks for watching this video. If you found it helpful, please give it a thumbs up and consider subscribing for more content like this.